Good evening to all. Very warm good evening to the one and only Prasanna Krishnan sir, who is here to speak on the budget and with as far as indirect taxes are concerned. We had one session yesterday. We have continued this session only to see that the left out things are taken or we better understand the things. That is the idea we at the SIRC had. So the consecutive day of analysis of budget proposals for the second day by SIRC, in the absence of our chairman, I have taken the responsibility of conducting this program today evening. So a very warm welcome to all the delegates here, and thank you for your participation. But for your participation, we would not be able to do the programs so consistently. And more than that, I would say the stalwart speaker like Prasanna Krishnan sir and Jain sir are kind enough to accept our invitation to present their views on the union budget presented 2 days ago, and to give the insights of the indirect taxes. We have with us Prasanna Krishnan sir. So a warm welcome to you, Prasanna Krishnan sir, from the SIRC. And also will be joining the past president of the institute, Jain sir, for direct taxes. Before he joins, we will start off with the indirect taxes. And before I hand over the proceedings to Prasanna Krishnan sir, it is customary and my duty to introduce him in a very briefly. I take that opportunity and the pleasure of introducing. Prasanna Krishnan sir is a founder partner of a Chennai-based firm practicing chartered accountants. His professional specializations is in the field of tax laws, especially the indirect tax laws, with a specific focus on GST and customs. He is a successful indirect tax law counsel, appearing before the Honorable Customs Excise and Service Tax Appellate Tribunals, the Director General of Foreign Trades, VAT appellate tribunals in various states and customs appellate authorities, different GST authorities, including GST appellate forums, AARs, and National Anti-Profiteering Authority. Representation to the governments. Hitherto, he had directly been instrumental in several exercises, VAT, service tax, and GST related developments by interacting with the concerned ministry and or bureaucrats. His suggestions relating to customized compound levy scheme has been acknowledged by the Honorable Prime Minister's Office on 24/7/2015 for favorable consideration while implementing it in strategies, in stages, the GST Act in India. So in India, in January 2018, accepting his representation on contradiction between GST circular and GST notification, the CBIC Ministry of Finance, Government of India issued corrigendum. In Finance Act 2019, enacted in August 2019, major part of his suggestions to set right the unintended denial of exemption from GST registration for goods vendors, notification number 10/2019, CTR has been duly considered by the Government of India, benefiting lakhs of such taxpayers. In April 2020, his view or idea were returned to the Ministry of Finance to enable OTP-based GSTR filing options to about 11 million corporate GST taxpayers during nationwide lockdown was accepted and implemented. Reference notification number 48 of 2020 CT. Both revenue and taxpayers benefited due to hassle-free compliance during the pandemic too. And knowledge sharing, he has contributed to few publications and also to the academic works of the Institute of Chartered Accountants of India. His views during official training sessions used by C&AG, Central Revenue, South Zone caused productive observation on tax on educational institutions to the tune of about 19.2 crore to the central revenue reported in AGAR 2016. He has handled ICAI CP seminar sessions throughout India. He has written articles, write-ups relating to tax laws in renowned dailies like Business Line, Excise Law Times, uh, the Industrial Economist, Service Tax Review, and the Economic Times. This, in brief, is what is Prasanna Krishnan sir. That's how he has been an erudite and very elegant speaker. Over to you, sir. We are very eager to hear you. Once again, warm welcome to you.
Honored brothers and sisters, good evening. Whether the screen is shared, can you kindly confirm?
Yes, sir. What is the slide chosen?
Just move to screen mode.
Yes.
Fine. Yeah, today's discussion will just be focusing on indirect tax related proposal by this Finance Bill 2022. Before entering into the very core aspects of this particular budget, we may have to get into certain numbers which will be of very importance. Can kindly have a look on the screen. There's a comparison of figures of 2020-21 and both original and revised, 21-22 budget and revised, and also budget. The first question will be, see, as a chartered accountant, why should I see this? Why should I learn this? Maybe a question. What is the need for me to learn this? The advice from my side is, maybe after some 3 or 4 minutes, you will confirm that you have to learn it. Okay. But my advice is, only when you see these things, you get a complete idea about what is budget proposal and how it is affecting you. And as a chartered accountant, how you can advise your client. From the budget, what you can read and what you can understand is little different thing. Budget is different and reading budget is different. Understanding budget is totally different. That is how we have to consider. Now, coming to this one, there is a hindrance in the screen. Screen is visible?
Yes, sir, visible.
For me, it is getting cut. I'll just adjust it. Because my screen is getting cut. Because I'm comfortable to read on my own, but you will be feeling comfortable if I'm finding out in specific. Fine. Okay, let me just manage. Right now, if you come to these numbers, we'll just check out these numbers without spending much time or briefly on the specific points alone. If you take the customs related figures, you can have a look on that. It is, say for example, 2021-22 revised figure, 1.89 lakh crores. The estimated or budgeted figure for 2022-23 is 2,13,000 crores. The first point what you can understand simply from this is, there is no serious expectation about the import of goods. There are certain reasons, if time permits, I'll just tell you. But still, how are you able to see that the figure of customs duty going upward? There is no serious proposal or anticipation about the anti-dumping duty or safeguarding duty, which is very exceptional, not going to contribute seriously for this kind of hike. Very simply, you know very well, about 350 plus goods already had been exempted by various notifications and a set of notifications. Now law has been, what I can say, right-sized and set right in such a way that you have to refer to 3/2022 customs tariff, maybe 15/2022 customs tariff. You will be able to see the complete history. More or less 350 plus goods have gone out of the exemption. So my sincere advice will be from 1 to 2022. If you want to advise in respect of customs and exemptions, better you unlearn everything what you know and see once again. Kindly just forget whatever exemption notification you know. Check it up whether those notifications are still effectively continuing there by the aforementioned notifications. Now, having said that one, how about the excise? 3.94 lakh crore rupees was the revised collection in respect of 2021-22. That itself was high actually. Now you please note it. In budgeted 2022-23, it is going to be 3.35 lakhs. A simple guess, I won't say that's a professional estimate. A simple guess what I have is, it will be a little wild guess indeed. There is a possibility of reduction in the petroleum product within short time, or maybe in a distributed manner. This is a wild guess. It may happen, or maybe this may be a reason. Another reason may be electronic goods or electronic vehicles are getting into the roads. That may reduce it. Even if it is there, there are certain statistics which are saying that about some 7 to 8% impact can be there. Here, what you are seeing is 394 is coming down to 335, which is very clearly showing that more than some 14-15% reduction can be there. So it can be by way of a reduction in the price, is a guess actually. That's all. We have to go to the details. Service tax, it's already ruined. There is nothing there. Only thing is there are some legacy cases which are continuing there. Those cases and things may get a little more revenue actually. Otherwise, nothing serious about it. Maybe the old cases which are already open, already they are given the advices to see that the commissionerate level people or commissioner appeal also expediently dispose the work what is there in their desk. So that may be another reason. Then the hero, GST. The share of central government 6.78 lakh rupees revised estimate 2021-22. It is to go to 7,86,706. It's okay, sir. It is after all showing the number. What is special in this? That is what's special. When you see this, you can easily understand that there is a possibility of serious revenue collection actions, or ITC may be another, that is another usual target area. So that can be another area where they will be focusing a lot to see that easily the ITC is not available to anybody. Or there is another possibility that there are some cases where you have leisure payments or a kind of payments which are not perfectly in compliance with the law. Those things will be plugged in. So that loopholes will be set right. And there is a possibility of higher amount actually. So this is what we are able to see. These serious actions, what can be possible? There may be interception actions can be more, or raids may be more, audits may be more, investigations may be more possible. These are all possible because what a poor officer can do, you have given a target to him and you need to do this. When you are compelling him to do this, what best he can do? He can after all try to do whatever is available there. Generally, the pressure what they are getting or what is exerted on them is just directly going to the taxpayers. That's an unfortunate situation in this kind of departments that in the past, maybe if the future is good, that's really good. But what will be a possible, what I can say, escape route for an officer who is under pressure? When the target is given there, he will be trying to do it. Commissionerate way, there are certain informal understanding that what will be in the collection actually. On that basis only budgets are drafted. Naturally, they have a serious pressure in this respect actually. The screen is not moving for me. You may kindly just excuse.
Maybe we'll stop the screen sharing and we'll reshare it again. So instead of putting it in the slideshow, we'll have it as a normal mode.
We will have it as a normal mode itself because the size is bigger.
Maybe due to this presentation, it is getting hanged out, it seems.
Yeah, this due to the presentation, it goes that I think.
We'll stop the slideshow, sir.
Yeah, I will stop it.
Yeah, now it's stopped.
Yeah, 1 minute. I will just come back. You may kindly just excuse. I think the size of the file is a little bigger, so it's not able to manage and go. 1 minute.
Yes, sir.
Just stay with me. Were you able to see the screen?
Yes, sir. Visible, sir. Visible.
Fine.
Continue this way, sir.
Only thing is you may kindly just excuse, the size will be slightly less limited, but still it will be readable, I believe.
Yes, sir.
Okay. Yeah. So So 2022-23 direct taxes versus IDT ratio we may have to know. Again, as started warning, we have a lot of takeaway from this also. It's not merely for statistics or number crunching or something. See, out of total tax revenue budgeted for this year, that is 27,57,820 crores. Last year, the revised budget was 25,16,059 crores. The expected indirect tax collection this year, 22-23, is 13,33,706 crores for central. So the union government is going to have about some 48.36% of the tax revenue from indirect taxes. The balance money will be coming from naturally the 51.64 something percentage should be from the income tax. What is the importance of this? This importance you can learn from the previous one. Just see in the parenthesis, the revised figure of 2021-22 was having 50.17% of indirect taxes. Balance was the direct taxes. That was the situation at that time, last year. So the trend will always be like this. The past, I have seen about some 15 years budget continuously, and some more year also backwards. The trend is, if your indirect tax collection percentage in a year is less than what is your direct tax collection, subject to very few exceptions, some new policies, new revolutionary tax trend, other things, and I'll leave it. Generally, without any extraordinary items, generally, when your indirect tax collections are increasing, then naturally the next year direct tax collection is huge. Naturally, the next year your indirect tax collection comes down, and it goes that way. So more or less this is happening there year-to-year basis itself. Very rarely after effect of maybe 1 year or something like during election years, double budget years, that can be some exceptions. So the lesson what we are getting here now is your income tax collection for this current year is going to be high. So that will give a lot of ideas. We will just discuss if time permits about this one, what to do in this respect. Then the next short point we have to note and then get into the other aspect is this one. In the screen you are able to see 2017 related disputed and undisputed tax demand. Disputed demands are here. I just rounded it, about some 38,875 crores something. Undisputed. What is this? What is the meaning of this undisputed? It's very much forming part of receipt budget actually. They say that they are unable to collect the money from these taxpayers who are either bankrupt, not available, vanished, maybe address is wrong, non-traceable. Officially it has been told. So these are the cases. So now if you see the next figure of this 2019-20, you can see these figures going up. Please just be with me here, 133,520. Then you see here, it grows again. You go to the 2020, it goes to this much big, very big number, 2,55,367. In simple language, we'll talk. 2,55,367 crore worth rupees could not be collected, though it is disputed. There is no one is there to come and dispute actually. Yeah, I won't say that there is a case or appeal or dispute or something. Nothing is there. Person is not traceable. That's all. This is how it is. And if you see here, much dangerous and worrisome matter, 10,42,608 crore rupees something is the disputed amount actually. You can see the split. I don't want to spend time on that. You can see the split. These are all the tax disputes and the value involved there. Now the current situation is, you please remember after the Sabka Vishwas scheme which was brought inside, legacy dispute resolution scheme also, 2021 ended by the end of 2020-21. These are all the official figures. You can see here 4,05,583 crore rupees could not be collected, though there is no dispute. As I told you, of course, you can see the reason printed here itself. This is official reason, not appended by me. It's official reason. You can just read this one. In these cases and all, there is no asset to collect. There is inadequate asset to meet this. Or recovery is not possible. Asset is not traceable. That kind of items are this. And you do have 12,13,000. It was earlier 10 lakhs. Now it is 12 lakhs. So how it grows, you see. This is giving a hint that there is a serious need for, which in short time it will happen. There is a serious need for reviewing the tax administration system itself. how you are going to handle the collectible money. Shall I just say in a simple example? What is the annual collection of entire indirect taxes for the budgeted year? About some 13.33 lakh crore. That's what before 3 minutes we saw. See here, 12,13,809 crore rupees is there in dispute itself. I am just saying in utopian condition, only just imagination, mild imagination again, you just keep it. I say for some or other reason, your 70% of the amount is getting settled by way of a scheme or some faster adjudication system or appellate system or better court system or something like that. For this, what the government is doing is, let me say, out of imagination, that about 1 lakh crore rupees is spent on court, judges, and all these arrangements, infrastructure. Suddenly, just imagination. And the target is before the end of 2022-23 January, we should close all the cases. Give maximum five hearings. Thereafter, no hearings. Case should be closed. And you will be able to see the result of this 12,13,800 crores. It need not be always revenue oriented, but whatever best revenue can get, let me say that 15% of this is the success. Let it be still there. The calculation is perfectly fine. The tax administration cost, record maintenance, so much of documentation, human hours loss, so many things are involved there which could have been done and employed in productive matters, not there. So, a prudent decision within short time by any government will be definitely taken in respect of this. Such decision will make a complete change in the tax administration system itself within short time. It's a compulsion of time. It has to happen, it will happen. Well, here we will just start with the customs related but important amendments only. Actually, all the total number of amendments in the indirect tax itself is very limited this time. It's a very small one, in fact. It's easy for us to discuss also. There are some important, very silent changes also which are affecting your day-to-day work also, day-to-day plans, your customers, clients, future, of course, are also there. To start with, customs. Customs are having very limited, less than a dozen amendments are there, and important amendments maybe 3 to 4, I think. That's all. Who is a proper officer? No, I'm not making any fun actually. This is what has been redefined. I never questioned this. Who is a proper officer in Customs Department is not the tone which I asked actually. The government itself has asked itself and redefined that one, saying that this will be the functions carried out by the following persons, and for this purpose, these are all the people who will be coming under the category of proper officer. That's what they have told. Now you have a doubt. To our knowledge, about some 60 years plus, 70 years plus, the customs law is there. What is the need for defining an officer under Customs Act to be a proper officer or not now? Where comes the need actually? Of course, the cases like Canon India Private Limited versus Union of India, beautiful decision actually, no doubt, Supreme Court decision. There are 12, 13, 14, well drafted. And voice of justice, nothing important. The additional director general in that case of Department of Revenue Intelligence had issued a notice and returned the process of adjudication, and it was clearly a violation of what has been told in the basic law. Who is a proper officer for the purpose of this adjudication process to be started and conducted? For investigation, for any kind of the inquiries or any kind of actions to be taken, including the confiscation, these, that, and all, there are certain powers given there in the relevant sections. But for the purpose of adjudication, for the purpose of specified works, can anybody do without being properly assigned that work duly under this law? That is the question. It was answered in favor of SSC. Of course, Delhi Tribunal also, Gst also followed in case of Switzer Engineering Laboratories Private Limited on 15th November 2021. And one more case, Kitchen Essentials versus others in Mumbai High Court. That was also strictly following this case also. So these are all the questions asked actually, for which reply is coming there. Just on the lighter side, I just met one politician in the airport, and where he was standing there was a pen near him, beneath him, of course. I believed that it was his pen because he was the only person sitting there. So I picked up the pen and went to him and said that in the airport, that, sir, is it your pen? He just saw me and said that, are you going to so and so place? Yes, I'm also. Let's go. We went together. We went in the bus and we got into the flight. Incidentally, our seats were very quite adjacent only. We were sitting. Again, I asked him that, sir, is this pen yours? No, that we will talk later. Yeah, and he talked something, and after some time it was silent. Then we got out. After alighting, he just told that pen is not mine. He told. I was really surprised. This could have been told when I asked there itself. Why it was not told? Then my friend who was near to me told in his absence after he left. Sir, he is there. He was there in the parliament for a while in the session. Then now only he is just coming out. Being a person sitting in the parliament for a long time, answering to the question in the place at which it was asked might not have been the habit actually. It would have gone out of him because he was there in the parliament for in a long session actually. So it may be the reason actually. So whenever questions are asked in the court, they will not go to the court and win in the court actually. Naturally, they will go to the parliament and say reply to this actually. The question what has been asked in the court will never be answered in the court. Rather, it will be answered in the parliament hall. This is what has been done. So coming to this matter, this is the answer given by the lawmaker saying that whether a proper officer is a proper officer or not is told here only, very belatedly. Fine, The next set of details are to be noted here is a large number of goods, as I already told you in the inception of our discussion, have been classified as not exempted goods. Means they are liable to pay customs duty when they are imported. Kindly just unlearn whatever learned in respect of exemptions relating to age-old exemptions relating to the import of goods. Kindly just go through the present structure from 1 to 2022. You will be able to have a lot of inputs which will be useful for the persons. And is there any serious reduction in respect of import duty or something like that? That's the response to what you are seeing in the screen actually. Seriously nothing. As few goods are there, fine, by and large, either maintained, to some extent reduced in some cases. There are certain life-saving certain items are there, fine, but by and large, it is maintained or it is increased. Either of these are there. Loudspeaker, earphone, headphone, these are all the things are there which we need not spend time on. It's not worth to spend time on that also because it is supposed to be independently studied in case of every import. Just in a seminar in 3 minutes or 5 minutes, we cannot just list out and read it out like a newsletter, which is not going to help us. And advisable to see that on a case-to-case basis, you study and do the classifications sincerely. In line with the developments made by the World Customs Organization recently, CBIC has come out with a very innovative step with a detailed bridge document, namely the correlation of customs tariff between 2021 and 22, what you are already having and what has now changed to that one. It's a very bridging document, very nice one actually, published free of cost. You can just download at any time from CBSE's website, readily available there. Every single aspect has been explained. What you know, from that you can go to a place what you don't know. That's the kind of link they have given there. Very professionally prepared one. So in this case, whatever you are able to see, the subschedules are there or the notes relating to that one, especially the fine-tuning of the last 4 digits of that one, heading and subheading in the chapter, well defined actually. There had been some gaps actually in certain important codes. They have just tried to see that is getting properly filled, and they are given in separate color. Red color alone will be showing you that what is new. So if you go to your related chapter, something like chapter 85 you want to go, chapter 38 if you want to go, in that around 3804 you want to go, you just go there in red color letters. You can see those who are in serious practice will be finding it very useful whenever you need it. Let's now move to the goods and service tax related amendments. We may be requiring another 20 minutes or 23 minutes maximum. So we'll spend that on that after this. As far as goods and service tax related amendments are concerned, a lot of procedural amendments have happened. This law has become more or less settled, not settled, more or less settled. And there is a need now for them, either for the government, either to continue what has already been done. And there is a need to do some kind of purging actually. Here and there, some kind of wrong things are there, they have to set it right. More or less it has settled actually. Whether the original GST intended by the lawmakers by the EU of 17/2017 is the one what you are having now is a totally different question about which we need not discuss at this moment. Already it is 4.5 years old child actually. Now we need not discuss about whether this is a C-section delivery or a natural delivery. That is of no serious importance now actually. The child has grown, it has started to work, and now it is good actually. It is supposed to go to school now. Fine. Now coming to this particular matter, there are certain needs, certain inconsistencies should be set right. They are sitting right. Slowly, the real GST's grip is coming now. Under the clutch of taxmen, this business environment is coming there. It should be gentle, perfect, lawful, and it should be relatively user-friendly. That is taxpayer friendly. That is the right way to proceed. Actually, we will see how it is going there. Coming to this one. Section 16 subsection 2 thereof is getting one subclass BA. What is the effect of this actually? It comes to say that the details of input tax credit in respect of the supply communicated to such registered person under section 38 has not been restricted. Then that is an eligible ITC. What they come to say? Gstr 2B, you know very well. What is this Gstr 2B? For beginners, I'm just telling, not for the learned members. In case of supplier doing supply to you under GST with the proper invoice and filing is GSTR 1, his details are reflected in GSTR 2B. He should be a person who is properly filing his return and paying his taxes. Then only you are able to see in 2B. So you are recipient, you view your purchases in GSTR 2B. In simple language, for our understanding, I can say this is the 26 AS of GST department. That way you can keep it. Just for easy understanding, I'm just saying. So, as a recipient of goods, you are seeing the 2B. Earlier, you had been seeing 2A, which is just merely a presentation of GSTR 1. 2B is confirming that guy is a regular person who is paying the tax also. So, that's the case. What it is asking for is there should be no restriction in claiming this. There is a possibility of somebody being restricted. So, you should also be honest. Your supplier should also be honest. He should have filed properly his return in time. You should be able to see that without any problem. Then your credit is yours. That means perfection on A side, perfection on B side brings you perfecto perfect. Then it's fine. Otherwise, defecto defect. You will not get the credit. Now coming to this next important section. We are seeing only the important amendments. We are not seeing all this. There are certain sundry minor things and all where it reads that maybe section 3810 or 3910. We will be reading that if any person it will be started. They will say that where any person is that and all not serious actually. But we are trying to cover without compromise all the major amendments without any compromise. That's all the thing. Now here, section 29(2)(b) and section 29(2)(c. are being amended. These are all relating to GST number cancellation. Already these are there. When it comes to the section 10 parties, the compound levy parties who are paying that 1.5% of that one or some small rate of 6% of that one, these are all the parties are there. We tried our level best to see that this is getting settled. Still some more areas are there. I think lawmakers will be responding to our representation. So let us see. Now, coming back to this one, the law hitherto reading that in case of a compound levy party, his number may be cancelled by the officer with his suo motu process when his returns, what he is filing the returns, are not furnished for 3 consecutive tax periods. 3 consecutive tax periods. By mistake, it was reading that way only till that date. What is the convenience is for 3 consecutive tax periods means the section 10 parties who may be having less than 1.5 crore rupees turnover, he may be having his own return filing, maybe possibility of quarterly return if any. In some cases, will be able to come back and say that 3 into 3, 9 months time, because one tax period is 3 months. He may be able to come back and say that I will be fine. You will have to wait till my default for the consecutive period of 9 months time or 3 tax periods. Maybe the case, maybe. In the past it was. So what the department represented to the government is literally we are not able to do anything in this case. For 9 months we are just having our hands tied. Do something for this and untie it. Then the government has brought in this amendment saying that the return for financial year beyond 3 months from the due date. That means that if a due date comes in 3 months, if you are not complying with, and when you are still a defaulter after such 3 months time, simply there is a possibility of your officer taking up this matter for suo motu cancellation process. Next, any registered person other than the person mentioned above, that is this section 10 guys are different. Normal taxpayers at normal rates are there, who has not furnished the returns continuous tax period of the period. See, the continuous tax period as may be prescribed is the word they told. So it may be 3 months also, and to our surprise it may be 2 months also. 1 month is too smaller. I don't want to say it as a guess actually. Okay, fine. So there is a possibility of CBIC notifying that not filing returns of 2 months, not filing returns of 2 months by the normal taxpayers can make them to end up meeting GST and cancellation proposal. Possible. Then, of course, you do have the procedures, but it's little dangerous. That's what I told you. Slowly, the clutches are started to work actually, and it will be understood over time. Now, Section 34(2) getting amended. GST credit note issue. Everybody, to my knowledge, of course, not I will say everybody, most of the taxpayers and others were happily saying that credit note issuing time has been extended very reasonably. All these days, what was told is beyond September, you should not issue the credit note for a particular year. September means subsequent. Say, for example, 2021-22 is the current year. For this year, a supplier can issue credit note up to September is the provision now what you are having in that section 34(2). Now, this amendment is proposing from the date on which it is going to become a finance act that this kind of credit note, GST credit note, can be issued even latest by 30th November 2022 for this current year. So first response from you will be what? Very nice, very pragmatic decision. We are giving reasonable time now, and the trade will be very happy. Yes, perfectly right. That's okay. But you will have some serious impact. Are you able to imagine what can be the possibility? You are an honest taxpayer trying to file your returns and annual returns in time. You want to finalize the things in time, right? So somewhere in the month of June or July, you finalize your accounts and things and all. There is a possibility for your supplier to issue a credit note even by November. Say, for example, somebody is saying that for a supply what has been made in the year and month respectively, April 2021, April 2021, credit note is issued by that guy to you, that to GST credit note, financial credit note. GST financial credit note is issued by him, let me say on 29/11/2022. For what? For the supply what has been made in April 2021. You have finalized your books of accounts, and for all practical purposes, you closed your books. Now you come to know that he is reducing your GST ITC. Why he is reducing his GST? Because he is giving GST credit note, right? He has got right. Legally he is right. So now how will you be able to handle this? Practically it's serious. So how far we can try to see that both sides are balanced? There are certain suggestions, maybe we are written, we will see whether government is able to relook this, how to set rate this, and all we have to see. Once a trade is having requirement, no doubt about it at all. Yes, trade will be happy, they are happy indeed. A lot of television programs or a lot of write-ups and other things. And this is very practical decision, of course. This is right, we need it. Government has understood our problem. It's fine, all fine. And what about this problem? There should be a solution. Of course, we'll discuss after a while when we are finding time in the same session. Now, coming to this same section, you have some modifications done in respect of the same 34. Here, what it is reading at present is, they say that here it is simply reading that in case of a registered person other than the ICAIs or non-resident or Section 10 parties who are compound levy scheme guys, or Section 20 or 51 parties who are TDS return filers, Section 52 parties who are TCCR return filers. Leave it all normal persons is referring to. There was a use of a word that they shall file, furnish the details electronically. That's what the thing actually. Now it has been removed. That has been removed. What is the reason for that removal? Again, court decisions. There are certain cases where it is told that whether it is electronically or otherwise. Queries are raised that electronic is right or this one is right. Even the port, whether has been used duly for the purpose or not. GST and port should be replaced where Showcase notice to be detailed. Did you serve that way? You did not. So no, it's not illegal. That has also been there. So just to respond to that one, sundry corrections have been made. Come to proviso to 37. That has been deleted. No proviso now in section 37. Earlier it was just providing that on or before 11th you should file, or else on or before 11th you should complete. 11th to 15th you should not file at all. In other words, up to 10th you can file, 11th to 15th you cannot file GSTR 1. It was there in the book. It was there. You will be surprised. Then how did I file up to 11th? That's the contradiction. It was reading that GSTR 1 should not be filed. For easing of the process, difficulty removal and all, there were power adequately for the board actually. During pandemic and all, they came up and said that you can file belatedly, much belatedly, further belatedly, all this. Now it's an hindrance actually. Having this hindrance inside the book of law itself is not good and doesn't serve the purpose. So they remove it. And in line with this one, 42, 43, 43A, all the stories are there. We'll just discuss within a few minutes. That also got completely sweepingly removed. Now, 37.2, that also fully deleted. Today I'm just talking a lot about the deletion section. As I already told you, it's a process of pruning or purging actually. Now, I think a good gardener's work has been done by the government. Okay, let's see whether flowers and fruits are available or not. Now, the following subsection 37.2, what was talking about this 38.3 and rejection and acceptance of credit given by the person between the so-called days. These are all the complicated one at the initial stage we were told actually. The system was not that much cleared up. That is, you should give, I should accept, I can reject. If I'm rejecting, it will come to you. You should play still, I will reject. So much of complications. Now they have found out a different path. They have just deviated from that one. So the world is no more of any relevance actually. It's going out actually. 37.3, it is giving you more time for you to rectify your mistakes. See, you file your GST returns regularly. 21-22, again the current year, you are keeping on filing it. An error relating to 2021-22, you identified and you want to correct post March 2022. Can you do it? You can do it. What was the time all these days given to you? It shall be the time by which you will be furnishing your returns for September month. What will be the third one for section 39 purpose? Gstr 3B will be filed on or before 20th October of the relevant year, maybe 20th October 2022. Now what it is reading is, it is not 20th October 2022, rather 30th November 2022, 40 days extended. Again, you will be happy. Fine, sir, it's nice. They give some more time for me to correct my mistakes. So I'll be very happy to do it. As I already told you, impact is different actually. You give a clearance there also for credit note. You give an extension for 3B also. The lengthy time is going to have its own impact in respect of final filing, at least in respect of GST annual report, impact will be there. Because till September month, let me say midnight of 30 November 2022, there will be always some ups and down hectic movements of my credits. Let me put in simple language like this. My 26 years will be going up and down reasonably for a while, and once it is done there and certificate is issued there, I get a clarity. But if my 26 years of 2021-22 is keeping on corrected and deleted and removed, what kind of pressure and problem I'm facing? Can be the, or much serious be the problem what I'm talking about in case of Gstr 2B going up and down. It goes up and it goes down, and if they are correcting it, what will happen there? We'll have to see. There are certain easy methods electronically what they can plan actually. We will just wait and see how procedurally they are telling. At the outset, this is what it is looking like. When it comes to the practice, there will be some kind of acts of safeguard and limitations generally. Let us see how they do it. Section 38, furnishing the details of inward supply completely substituted with new version. Completely. What is that one? Auto-generated details of ITC, whether eligible ITC or ineligible ITC will come to you. Will come to me means what? I have to log in, I have to see my return, the figures will jump and come and sit inside my ITC figures. This is what is already happening there. This is happening there without any compulsion. Now we have to see that how they are going to do it. The doubt is what will happen if I am regularly filing the returns in time. Say for example, between first day of a particular subsequent month to 11th day of a particular subsequent month, if I'm doing it, I will not have these 2B figures generated. So the government will be asking me to do it only after 11th, because till 11th they will be filing. My supplier will be filing. Eligible and ineligible credits I can know only by a time post 12 o'clock midnight of 11th day of a particular month, right? So only when they file Gstr 1 and freeze it, then only I can see it. Sir, now also the same problem is there. No, they are saying up to 13th you don't see, by 13th, 20th, all fine. I have an assurance, I have a clear assurance that there is a possibility of me correctly putting the numbers and the system may go mechanically wrong. Say for example, I imported some goods in the month of, let me say February 2022. Now, I did not take the credit for some reason, maybe a silly reason, clerical error. I have a right to take the credit, let me say in the month of March 2022. The import related detail through ICAI has well been established, it is getting reflected. What if the machine is understanding very mechanically that the credit relating to February is reflected in February, whereas in March it is not available? Because in March I did not import. Just take a simple example further, that the same way I am supplying goods to you. Mr. Pannaraj of Karnataka is my customer. I am sending goods from here. Mr. Pannaraj opens this Gstr 2B and sees that one. For some reason, he was busy with this regional council meeting and he is a dedicated person for the institute. He forgot to see his own business seriously. He missed my credit, what I have given to him. The next month when he is seeing it, is there any mechanism for the machine to understand that when Mr. Pannaraj is punching the details of February purchase from Prasanna Krishnan Chennai, will it be able to understand and see that yes, you missed it there, you take here? How it is going to understand is the question. Unless and until we manually go for it and just give clicks for each invoice. For doing that each invoice presentation, the size and the response of the GST website we know very well. After a long painful time of about some 3.5 years plus, now it is reasonably okay. Again, I'm not sure like the second version of income tax website should not be seen in GST website actually, because you need to see invoice wise. If you see the invoice wise and then say accepted, and you may accept, you will not accept, that is a different one. If you don't give that facility, how the machine will understand which credit is of this month? I pay reverse charge, I take the credit. If I fail to take the credit of reverse charge of the previous month, I have right to take in the current month. What is wrong in that? Reverse charge paid by me is available to me as a credit to me, maybe in the month or the next month. So there is a possibility, there is a serious possibility, or I'll just put away in a different way actually. See, on 30th, not even 30th, the current month I will take it up. Let me say 31st January 2022, Prasanna Krishnan is supplying to, let me say, again, my good friend, Mr. Pannaraj, if he is not mistaking me. I have not supplied anything still, I'm just taking for example. So I am a supplier from Tamil Nadu. I supply to him to, let me say, Karnataka or maybe Kerala, whatever it is. On 31/1/2022, I raised my invoice, put my EWB, and I sent the goods. So I punched that. Law is asking the recipient to take the credit on receipt of goods only. That is what section 16 is telling. So my goods and invoice are reaching him with proper EUA bill, let me say on, let me say today, 3/2/2022, after 3 days. So he believed that he can take credit only today, which is right. How the system is going to understand that 31st January 2022 data punched by me, presented by me in Gstr1 of mine and presented to his 2B is reflected whenever he is just seeking his credit in the month of February Gstr 3B what he is going to file. Hope you get the point. It's quite natural. On 31st January 2022, I sent the goods, I am a supplier. I presented the data in my Gstr1, it's perfectly fine. He can take the credit, it's perfectly fine. How is this going to be related? By a bulk number, if it is trying to verify, it is certainly misleading, misguiding, useless. If it is going by invoice wise, my sincere doubt is there as to the competence of the system, how far it is going to cooperate. We have to wait and see how it is going to happen. Now, 39.5. Furnishing of returns, Gstr 3B. All these days, non-residents were filing till 20th of the subsequent month. Now it is saying that on or before 13th of subsequent month, please file your returns. Very simple corrections. Of course, nothing seriously wrong. A non-resident is not having that much serious thing to wait and do. We can do. Again, 39.7 is getting amended. This is reading little different language now. The proviso, first proviso, got substituted. What it is reading now is, it says that you will be, the taxpayer will be paying the GST that is calculated by you. That is correct. That is sounding nice. That is self-assessed what you are paying. Maybe your GSTR1 related lead numbers will guide you what is that figure to be punched. All fine. Or, that's why the catch point. Or, such amount determined in such manner, subject to such condition. Which condition? So many such. Actually, the word such in Hindi is meaning the truth. Actually, what is the truth? We have to wait and see. Actually, this such I am able to understand. What that such is, such is what I don't understand. Actually, we have to wait and see. So the problem here is, it reads that Mr. Taxpayer, you pay the tax. Fine. What you want to pay, you pay, or the machine will tell you what should you pay. And what I should pay, I pay. Up to that, I'm very clear. Because I calculate something and I hold myself responsible. If something is wrong, you are going to issue a show cause notice within normal period, and if not in extended period, you are going to stamp me as a fraudster and give the notice. It's always there. Fine, leave it. But what it is reading is, you pay your tax what you calculated, or such amount determined in such manner, subject to such condition, and the restrictions means what will be the figure going to be thrown on me, I don't know. And I believe still that the machine will be giving me the option. See, this is what you should pay, the lead numbers will be given. If you want to pay something correcting this or erasing this, you pay, but it will be shown. You have modified the figures what has been shown in the figure system. That's what it may say. Because in the present days we are seeing, if you go to your Gstr 3B filing, take para number 31D, it is auto-populating. If you have filed a Gstr1, we'll talk some more matter regarding this. If you have filed a Gstr1 and go to 3B today, even today, in the past several months we are seeing, the one related number are automatically coming there as a suggested numbers. Even 20 paise is not allowed to be variant. 20, 11 paise is not also allowed. 9 is allowed, of course. 9 paise, 9 paise, 6 paise. And if it is rounding up and down, that is also a trouble. It shows in red color to you. So this is how it is auto-populating, but it is suggestive. It says that this is what the number you should present, we believe. But if you want to modify, you modify at your own risk. Fine. Now, if that is the kind of method it is showing, fine, well and good. It's okay. It is giving a suggestive, it is giving a corrective, it is kind of an advisory-based leading. It's okay, nice. Beyond that, if the concerned person is taking its own case, that's fine. But query and concern is it okay? if it is forcing. We have to wait and see what is going to be the process actually. I believe that it will be more democratic, leaving you to pay what you want to do. Now, here, section 39(9), section 52(6) in different times, it is different places it is getting corrected, and the effect is same. You can do voluntary correction of your omission and incorrect particulars up to 30th November of the following year, or 30th September following the year end. As I already told you, correction time, which was already there for as due date for filing the GST return of September, which is nothing but 20 October 2000 so and so. Now it is going to 30 November so and so. Yeah. So you get more time for you to do this process. Right. 39(10). Again, the GSTR 3B related matter, but serious twist it takes. If the GSTR 1 of a month is not filed by you, for that month you cannot file the GSTR 3B also. Now you can ask me a question. That's sir, then all these days what you have been doing, even in the present time also, if you are filing GSTR 1 and if you are trying to go for GSTR 3B, you have a hint, you are not filed it, it will show, but it will not stop you. You can file 3B. One without filing 1, if you go for that one, it will allow you. But now what it is trying is GSTR 1 of a month not filed. Then GSTR 3B of the month certainly cannot be filed. Cannot be filed. It stops. It won't be processed. So file 1, then only you can go for it. There had been cases, unfortunate and unfair cases, atrocious cases in practice where the suppliers used to file only GSTR 1 for 25 months, 28 months, 31 months and all. Had been there. GSTR 3B hasn't been filed in the initial stage, not now. Now it is different one. The range is reasonably lettered nowadays, reasonably experienced. Division is taking care. Some kind of headquarters intelligence are there. A lot of reviewing are happening there. So many other devices that are brought in, red flag systems they have brought in. They are trying to bring out this kind of cases. But there have been situations which were not at all fair for a society with good taxpayers. It is not fair. Their good taxpayer is not supposed to behave that way. And the credit has been taken by the opposite person because he just verifies GSTR 2A. First of all, GSTR 2A itself is not necessary. It was the period up to October 2018. Then 2A was brought in. That is also not fair in several angles for several purposes. So coming to this one, this is a welcome change actually. That kind of clutches should be there and will be there. Then only we will be able to differentiate who is good taxpayer and who is a bad taxpayer. Section 41 is all talking about the input tax credit claim actually. All this is what this law is saying is what the credit ITC you are taking is on provisional basis. You take it on a provisional basis. And it may be right or wrong. You can believe that it is right and you can proceed. That's what it says. Now, the section what it is reading all these days is you are eligible to use this for your self-assessed tax in your returns. You use it for your purpose only. That's what it reads actually. So now what it is trying or setting right and saying that is the modified language is saying that is you can use for your self-assessed purpose, use it. If you are reversing it for any reason voluntarily, you have your reason. Say supplier is not filing, 2B is not correct, your invoice is misplaced and you don't have that one. Some confusion or correction. The goods have gone for temporarily for some purpose out. Something has happened. You reversed. Then you can take credit of that one. Ensure that 2B is supporting you. That's always there. That is always a rider. If the 2B is supporting you, you can take the credit of this. Recrediting is also possible. All these days there was a confusion actually. Because what was the problem for you? If you are taking credit, the period will be the nuisance for you. Missing that one will be nuisance for you. Of course, natural justice has always been supporting you. This is now formally and legally supported. Already I told you. 42, 43, 43A, a very complicated theoretical process. A giving to B, B accepting it or rejecting it, rejected going back to him, B reducing that one, accepted by him, increasing his liability, paying that, showing here, 2A credit. So much of circles have been theoretically planned. All come to an end. Straight case. Are you a supplier? File your return. Are you a recipient? See your 2B. If you want to take credit ITC and if your business style is allowing the ITC subject to provisions of section 16 or eligibility related matter, enjoy the credit only after checking the 2B. Gone are the stories of this 20%, 10%, 5%, all this. You have the credit reflected in 2B, take the credit. You don't have it, forget it, go and fight with your supplier. That's it. And every day morning, whenever you are starting, just go to God if you are having any belief and pray that God, today I should have trade only with a supplier who is a very honest person and having a diligent accountant's team and a very good support from a chartered accountant. Of course, support from a chartered accountant means very good support only. That's different. And he should pray this way and come to his office and run his business. If not, for any fault of supplier, recipient is in trouble because he is not filing, then this person is in trouble. So they, over a time, the trade will be identifying some kind of a mechanism where they will not pay the GST component unless they see the credit in the 2B. Already it has partly settled. More officially and diligently, it will get settled over a time. That's what will happen because it's money. So I supplied a goods for, let me say, 100 rupees, and I asked my recipient of the goods, namely my customer, to pay 118 rupees under the banner GST collection, 18 rupees. Fine. If he is giving me 118 rupees, for 100 rupees he got goods, benefit settled. Fine. For 18 rupees, he should get ITC if he is eligible other way for ITC, so-called ITC. If that ITC is not coming to him, why should he pay to me that 18 rupees and cry with me? You won't. And at least if there is some kind of relaxation that if not this month, next month, if not now, next time, it's fine. If the law is gripping too much and saying that if you are having that 18 rupees, take. If you don't have it, don't take. 18 paise, nothing doing. 18 rupees, nothing doing. 18 paise, nothing doing. You cannot take that also. Ensure that what is there in 2B, take. Then what will happen? You will be very serious. You say that unless and until I get that figure, I won't release it. First, I will release your supply value, then I will release the GST value after seeing the credit only. This will change the environment totally, and there will be such related developments in the business as well as the consultancy given by the chartered accountants in this respect. And there are sundry amendments. Retrospective amendments are also there. For some time in the past 7-8 years, too much of retrospective amendments we did not see. To some extent, we were happy. But again, the trend is gone back to the olden days actually, and they are going for retrospective amendment to settle the things. Only thing is, it is not too badly affecting the interest of the taxpayer, except certain cases where some injustice is there. But by and large, what we are seeing is this kind of corrections or amendments retrospectively are done little, what I can say, I won't use the word hasty, in a pressure they do. And a lot of cases are there. What right you are having to do this amendment? How can you do this amendment? Where the law is permitting you? These are all the questions asked in the court of law. Then to respond to that one only, these kind of amendments are made by them. That section 50, subsection 3, take for example. What it said last time, if you are having ITC, if you are having a liability, 1 lakh rupees you have to pay as tax. Fine, total liability for a month. Out of this 1 lakh rupees, you tried to use, let me say, 70,000 rupees of your ITC, perfect eligible ITC, no dispute. If that is the case, what is a fair environment? 100 rupees minus 70 rupees, 30 rupees is the cash what you are trying to pay. The ITC is nothing but a paid money, already committed money. It is your money, the recipient's money, right? So 100 minus 70, 30 if you pay, if the interest is required to be calculated on the 100 itself, that was the version what the law was reading. GST Council already quite long back told that this is not fair trade as represented. We will correct it and ensure that interest is collected only on the net figure. A lot of case laws, including the Madras High Court, a lot of decisions have already come. It took a long time for the government, about 3 years plus, to come back and say that yes, we are sorry, we should not collect the interest on the gross liability. Rather, after removing the ITC component, balance net cash what liability you are having, that only will be liable for the interest calculation. They came out, of course, belatedly. Now you do have a lot of questions that how you do is what kind of notification you are having it to issue the notification, what right you are having, Who gave these powers and all these questions are there. Take for example, this circular one, CBSE circular was issued on 30th September 2019, the GSR circular. It was talking about the supply or not is a question relating to liquor license granting by the state governments. A lot of cases already have been there. A lot of questions during service tax period and during later also. In mining industry also a lot of questions about the mining rights related geology department collections. This kind of things are already been there actually. Seigniorage collection is a very famous topic going in Andhra Pradesh and Karnataka. That's a different one. Similarly, in line with this one, when the board came out and said that a liquor license is taxable or not, it is not a supply at all. Explain. Before that 5%, it is that they told. In case of, so let me say, fish meal waste, the chapter number 23, they came out and clarified the unintended side product. So that waste is coming out, that will be 5%. Something clarified on their own. SSC went to the court and said that what right you are having to say that? Your clarification mail will not be controlling me at all. That was the question. So what the poor government can do? They again go back and say that no, whatever I have told, rightfully I told, whether I have right or not, I am right. So that's the decision what they have told through the Parliament Hall. So the question what they have raised in the court of law got the answers in the hall of the Parliament. So these are all the amendments what they have made in this respect. Four amendments they have done. One relating to the interest amount, two relating to the ITC amount, interest excess paid amount for the purpose of using this, and then the liquor license granting is a supply or not, whether it is warranting RCM. This is a natural result. So it is not that supply, or the fish meal waste related transaction 17/2017 to 30 September 2019, all got confirmed that no, what we have told is right. We had a right to tell this, so rightfully we told as a government, follow what I have told. At any material time, we had the right to tell. This has been told by an act. This now it is built. Act will come there. So this is all we have today to discuss as far as indirect taxes are concerned. Subject to time availability to be confirmed by the organizers, we may take up questions or we may go to the next session, which may be at present ready. Over to the organizers.
Yes, sir.
Yes.
So good evening, sir.
Right.
I have only one question. We'll take it at the end.
Yeah, please.
So Panna sir, muted. So only one question will take it up and then we'll move to the next session, sir.
Yes, yes.
Sure. ITC.
Good evening, sir.
Yeah. Yes, please, sir.
Where's Jain, sir? Good evening, sir. Yes. Yes, sir.
Yeah, very nice talking to Mr. Jain. After a few minutes, I will be meeting in the screen, I think. Now I'm not able to. I have a different scheme now. Right now, the one and final question, of course. ITC taken in April month as per 2B. Fine, okay. Supplier orally agreed to debit note and hence reversed in May month by the SSC. Fine. It was not reflecting in 2B. It was, he is saying that I think he is referring to some debit note only. Okay, right. Then debit note was reflecting in June 2B. Fine, okay. Can the SSC claim higher ITC in June 2B since it was reduced in May 2B? Is a question. This is what precisely I was just telling as a simple case law or case study. The basic is when you are able to see in 2B, then you take the credit. This is what is the forced, I can use the word that way, is the forced option given to you. In a given month, if you are not having in 2B, you are not having eligibility to take it. So I do have an invoice in my hand. I do have evidence of making payment by bank to him. In a case, there was a need for some deduction of TDS under income tax, maybe even 194N for goods or maybe some other services like money, all fine. Yes, it's a genuine transaction, no doubt about it. Lot of corroborative evidences are there, no doubt about it. The short point is, do you have that in 2B is the question from the date of Finance Act enactment. At present, if you take credit, you can always present it under the category of this 20%, 10%, 5% matters, always. That's fine. Off the record, I'm carefully saying the word off the record. I can just suggest you that if it is a bulk calculation, you can always be supported by the teaming ladder. Which credit is this? You only can say, if the law says, you can say that what is the eligible credit as it is suiting to your need. In your given case, the April to be defaulter, separate the matter in June to be. So decide and see that what is there in the month of April is suiting to the credit what you have taken, and bring to that one by teaming ladding in June till the time there is no other solution. Hope you can understand the matter what I'm explaining to you. At the cost of another good speaker's time, I cannot take more time on this, but this is the version. If you are having further questions, you may kindly just write to us, we can respond to it. Over to organization. Yeah.
Thank you very much, sir, for your excellent presentation, and it was so interactive. Much of the questions could not be raised because of their very lucid explanations. Thank you very much on behalf of SIRC. A very hearty welcome to Jain sir from SIRC, sir. Sir, I am Secretary Pannaraj speaking, and I'll straight away hand over to you just by giving a small brief introduction about you for those who do not know you, or most of the people probably knowing being past president of the institute. I'll take pleasure of welcoming the erudite speaker, second speaker for the day, Jain sir, by introducing him. And he is from New Delhi, has been a man of prudence, veracity, and intelligence since birth itself. Academically very brilliant, and is a rank holder both at inter and the final CA levels. A triple bachelor degree holder. He completed his Bachelor of Science from Punjab University in 1973. A fellow member of the Institute of Chartered Accountants of India for more than 3 decades. On 5th of February 2007, he was elected by the Central Council as Vice President and was further elevated to the post of the President on 5th February 2008. During his tenure as President of the ICAI, he has earned various credentials which embark a new era of professional development. His integrity, zeal, and commitment towards the profession and society has been recognized and appreciated by the Government of India. Immediately after his tenure as President of the Institute of Chartered Accountants of India, he was assigned the job of reviving, managing, and the 2 associate companies of Satyam, and was appointed government nominee director on the board. He successfully managed these companies and revived the same. He is regularly involved in the consultation process of the Ministry of Finance and Ministry of Corporate Affairs, and members of various expert committees or panels constituted by the Government of India for fiscal and commercial legislations. He has made he has more than 4 decades of experience on advising corporates and on finance and taxation matters. Mr. Jain specializes in direct taxes and has handled complicated tax matters, appeals, and tax planning of big corporates also. A prolific writer, having command in Hindi, English, French, Urdu, and Punjabi, has authored many books on direct taxes and regularly contributes articles in various journals, newspapers, and frequently participates in various television debates, programs on economic, finance, and tax issues. With this illustrious career, sir is before us, and we are very fortunate to have you here, sir, today. Thanks to pandemic, which has made the technology possible to reach you out at your place, at your doorsteps. Thank you, and once again, welcome, and over to you, sir.
Unmute, sir. So you're muted, sir. Sorry.
Muted.
I hope now you can hear me. My voice is clear.
Yes, sir. Yes,
Yes,
sir.
sir.
Audible and clear, sir. Please.
Okay. Good evening. Thank you, Mr. Pannaraj, for that compliment and the introductions, so elaborate introductions. And good evening, friends, all my brothers and sisters from the southern regions which are part of this program. I may compliment to the chairman SIRC for extending invitation, giving me this opportunity to share my views on this Finance Bill 2022, which is the part of the Budget 2022 exercise carried out by the Finance Minister. Friends, as the Secretary, Mr. Pannaraj, was saying, pandemic has its own plus and minuses. Minuses are that we are tied down to our home. We are not able to meet physically. We are missing the what we call player of interacting and getting more and more information. But as a blessing is that we are able to reach out to large number of people. This has given us a new lessons to learn, and the Zoom communication, other communication that becomes so easy that one can access and one can communicate with anybody sitting any part of the world. And that's why sitting I'm in Delhi and I'm able to interact. I think most of you sitting in different part of the southern India, I can see roughly more than 800 participants in today's program, and maybe in many in Chennai, maybe in Cochin, maybe in Bangalore, or maybe in different places, which is there. Friends, my today's topic is mainly related to taxes, and that budget gives an hope to everybody that something you should get out of this budget. Budget 22 was not an exception. Before this budget was announced on 1st February 2022, everybody was making hue and cry, I should get this exemption, I should get this deduction, somebody should raise the standard deduction, somebody should threshold should be increased, one say ATCU investment deduction should be increased, housing loan deduction should be increased. Businessmen are crying that you extend our exemption, grant us a deduction. And the startup are also saying exempt my income. Multinational companies saying, yeah, you are taxing too much, take care of us. Everybody was saying like this. That was a scenario which is going around, and it is not unnatural. Everybody want to get something out of it. But when we look at the budget exercise, I think we as professionals, as chartered accountant particularly know that at the end of the day, budget is a balancing exercise. It is like a trial balance where debit and credit has to match. Similarly, budget is an exercise where income and expenditure have to meet. There cannot be any gap in that. And some of you may be knowing, and just for the knowledge of the sake for sharing with you, budget is an exercise where expenditure is first estimated and then the resources are mobilized to meet that expenditure. Somewhere in the month of August, September, the finance ministry writes to the various ministries to give an estimate of the expenditure which they are likely to incur next year. Maybe capital, maybe revenue, maybe whatever the account it is. And looking to the past experience, etc., an exercise is completed whereby an estimate of expenditure is prepared. And meanwhile, resources from where this expenditure is to be met are worked out. It is only in the month of December end and January beginning where a matching exercise starts, that this is the estimate of the expenditure and this is the income which we are having, how to meet this. How do we go ahead with like and work it out, plan it out on that basis. And this exercise is the most difficult exercise. And then pruning is done in respect of expenditure, some pruning is done in respect of income. At the same time, some resources are to be mobilized. If some concession is to be given, some pruning is to be given in the income tax, obviously that collection will go down, and to that extent, some resources have to be found out. And that's why the most important question for all of us to ponder over is that a concession given to one will be at the cost of a tax to somebody else. Now, if you look at the budget of this 22-23, some of you would have the chance to look at the receipt budget. The government of India has projected 14,10,000 crore rupees as a likely collection from the income tax for the next year. If government finance minister gives a concession to a tax clause, say if we increase the threshold from 2,50,000 rupees to 3 lakh rupees, 50,000 rupees, which is subject to tax at 5%, and 2,500 rupees benefit goes to every person. And if I multiply this by my 6 crore taxpayer, and considering that out of 66 crore, 50% will be taking this, will be falling in this clause, the immediate revenue loss will be 12,500 crore rupees. And if this reduction is to be worked out from the total estimation, something has to come up from somebody else. So that is the difficult exercise which is carried out. And that's why I'm saying that this budget at least has given credibility and stability by not extending any further exemption and deduction. This may not look good to many taxpayers who were expecting it, but look at it from a perspective that had this concession been given, somebody else would have been required. India has passed, I will say the entire world has passed through very difficult pace, still going on for the last 2 years. We are passing through unpredictable scenario in the future also. The finance minister could have levied extra taxes to mobilize the resources. So I gave an example that one should be thankful to the finance minister that she has not levied any extra taxes as against giving any concession. There can be two ways to look at a glass which is half empty or half full. You may say that it is half empty. Why it should not be full? I should get more exemption or more deduction. The finance minister says, look, gentlemen, this is half full. I would have half empty. I haven't made you full empty had I levied more taxes. That's a plus point, I believe. In that scenario, I believe this budget has given a credibility and stability, and very progressive budget, I will say, which is laying down the roadmap for the next 25 years, and next 3 years are going to be crucial. The way the government has projected the capital expenditure, if it is going to actually be implemented, I believe the scenario of India may change drastically, generating more employment, more opportunity, more infrastructure, and with a boom in the economy which is there. That's a scenario. In this background, now we'll look at the nitty-gritties of the various amendment which has been proposed. One thing I was wondering, when finance minister didn't make any change in the tax rate, etc., I was just wondering what will happen in case he has not made any amendment to the income tax act. People would have been happy, but what I would have done as a speaker speaking before you, I need to speak 1 hour before you. Mr. Panaraj, how much time I have?
We can have till 7:15. 7:15.
Okay. Another 40 minutes I will work it out.
Yes, sir.
Yes, I will work it out in my lecture library. So now what would have happened? If she would have said the way she said there is no change in tax rate for anybody, she could have said no amendment in the income tax act. But she can't do it. She knows people like us, speaker like us, need something to survive and make some amendment. And she was kind enough, I will say, to put 84 amendment in the income tax act, despite no change in tax rate. For me to speak, at least if somebody want to speak at least 3 to 4 hours, I can take 5 minutes, 10 minutes for one clause, and 84 into 5 will become 4 hours, 5 hours. That's amendment which she has made on the part, and that's what scope she has given to me to speak about. Now coming to one by one, what is there? One is the tax rate. Though absolutely there is no change in the various tax rate and slab for individual HF, etc., but there are 3 changes which to be noticed. One, long-term capital gain was being subjected to the normal rate of tax. We all know individual HF, AOP, BOE, etc. are taxed at a graded scale. We have a tax rate, and so the surcharge also increases with the increase in the income. If you have income up to rupees 50 lakh, you are not required to pay any surcharge. If your income goes up from 50 lakh to between 1 crore, you are liable to pay 15% surcharge on your tax liability. If your income is more than 1 crore, on the entire income tax liability, you need to pay it from 15 lakh to 50 lakh to 1 crore, 10%. From beyond 1 crore or beyond 1 crore, you need to pay 15%. And beyond 2 crore, you need to pay 25% surcharge. And beyond 5 crore, you need to pay 37%. Looking to the FII's demand, last 2 years back, she has reduced this surcharge from 37% to 15% in case of a dividend income and in case of a long-term capital gain arising from the listed security. So all FIIs were happy. But there was a concern that why it should not be applicable to all long-term capital gain. And the reason being obvious, because long-term capital gain, though taxed in 1 year, because asset get transferred in that year, in fact, it is an income aggregated, accumulated income of over a period. It is not in 1 year. It may be 2 year, 3 year, 4 year, 5 years income which get taxed in 1 year. So taking into consideration that fact, she has reduced the surcharge to 15%. So irrespective of the fact whether your income is more than 2 crore or not, you will be liable to pay 15% surcharge only. So that's a big reduction which has come, a benefit in respect of all long-term capital gain, not only listed share security, any share, any security, any asset, capital asset, maybe land, building, whatever it is. So that is a 15% rate. Now, what we need to learn as a professional? Now, having announced that this rate will be 15%, but will be applicable from 1st April 2022. So those people who are contemplating any transfer of a capital asset and the capital gain is likely to take their income beyond 2 crore rupees, if they do it now, they will be liable to pay higher surcharge, maybe 25% if it is beyond 2 crore, and beyond 5 crore, 37%. To avoid this, if they can postpone this transfer to 1st April onwards, then their liability will be, surcharge will be 15%. This is the message which one can get it. Another small change which he has made is about AOP, Association of Person, because AOP are also bracketed in the same category as individual and NHF, and surcharge applicable on them is also 37%. But many AOPs which do carry out various infrastructure projects in collaboration or as a joint venture consisting of companies, they say that our company get taxed at a lower rate, but when we do the same business as a AOP, then why there should be a surcharge of 37%. Taking into consideration this aspect, a small concession has been given for AOP consisting only of companies. All member of that AOP should be companies only. Then surcharge will be 15%. But in case any one out of them is not a company, then surcharge will be the normal 15, 25, 37 as the case may be. So this is a benefit for joint venture, etc., where all companies join. Some concession for cooperative society where MAT has been reduced from 18.5% to 15%. That's a small concession which has been given. And the fourth change when I was talking about is in respect of the tax rate applicable on dividend income received from a foreign company by an Indian company where it is holding 26% or more share in that foreign company. You will all know there is a section 115 BBD which was introduced way back in 2012, encouraging Indian companies subsidiary outside to declare more dividend and bring money back to India. You will know, I will appreciate it. When a company earns income, it is required to pay tax. When income is distributed by the company by a dividend, then only it get taxed. The company is not forced to pay dividend. So if any Indian company is having a subsidiary company in UAE and where it is earning substantial income, so long its entire share may be held by an Indian company or Indian person, that income will not be chargeable to tax, neither by as a tax and not dividend, because dividend is not distributed. So in 2012, the then finance minister Pranab Mukherjee said, I want to encourage those companies to distribute maximum dividend and bring back to India. And that for that purpose, 115 BBD was introduced to levy tax at the rate of 15, concession rate of 15%, and so that more and more money can come back to India. Now in this finance bill 2022, it has been proposed that this 15% tax is a distortion, because when 15% was levied, then dividend distribution tax was there, and there was no liability to pay tax on dividend income. Now, since dividend income is being taxed in India at a full-fledged rate, so there is no reason why it should be concession rate. So section 115 BBD will not be applicable after 31st March 2022. So any Indian company, irrespective of the fact whether it is holding 26% more than share in that company, any dividend received from that company after 1st April will be applicable at a normal rate, which can be 22% or a 30%, where the case may be applicable to the company, plus applicable surcharge and education cess, etc. So this is another change. And the lesson from the message from this is, in case you are having a foreign subsidiary company or a company outside India where you are holding more than 26%, it has got accumulated profit as on date. It is better to declare dividend and get back that dividend before 31st March 2022. In case you bring back that dividend, it will be under the old law, which is continues to be applicable till 31st March 2022. After 31st March 2022, it will be 30% or 22%, whatever it is. This is the message which in, or maybe then you don't declare dividend. That's the only issue. These are the changes which have been brought so far. What I consider is relating to the tax rate only. Now I come to few exemption and deduction. Salaried people were asking for so much benefit, whatever it is, maybe even medical reimbursement, etc., but that has not been given. But government has kept one promise which they made by a press release in the June 2021. You will all recall at that time an announcement was made looking to the second wave, which was a very strong wave, giving exemption to employees in case any expenditure has been incurred for treatment of COVID. of the employee or any family member of the employee, now that expenditure will not be considered to be a perquisite by the employer in case it is. Further, in case any financial assistance has been given to the family member of the deceased employee, that will also not be considered to be a perquisite. This press release was there. Now, to give effect to this, amendment is being proposed in section 17(2), where in perquisite it said it will not be considered to be a perquisite. Here, for the purpose of this, family member include only those family member which are part of section 10(5). You know, section 10(5) talks about the leave travel concession. So leave travel concession is eligible for the family member of the employee also. So in this definition, spouse, children, parents, brother and sister, if they are wholly or partly dependent on the employee person. So only those people in this, they are getting this amount. And for this, there is no limit and ceiling where employer-employee relations come. Similar amendment has been proposed in section 56(2). We all know that under section 56(2)(10), any person receiving from any other person any amount or any property other than from a relative where the value exceeds 50,000 rupees, then that becomes income from other sources liable for tax in the hand of the recipient. So in case any person has received any medical treatment or any compensation or a relief from any other person, that would have become taxable. But this budget says that any person has borne expenditure for a treatment of a COVID for any person or has given a financial aid to any family member of a person who has deceased because of the COVID, then 10 lakh rupees will not be taxed. Now, the language of the section is little difficult, which says in case it is 10 lakh or less, but idea is to give exemption up to rupees 10 lakh. I believe when the budget is passed, finance will come for consideration finally. Ultimately, up to 10 lakh rupee exemption will be there. In case it is beyond 10 lakh rupee, then that part will be taxed, but up to 10 lakh exemption will be given. In case it is receipt from relative, which is falling within the meaning of relative, then there is no issue, that will be fully exempt. But in case you have received from a non-relative, then up to 10 lakh rupees exemption will be there. So these are the two parts regarding exemption and deduction. Third, maybe a smaller part only, 80 CCD, we all know, contribution to the NPS. In case central government contributes on behalf of the employee, there is no ceiling. In case of other employees, there was a ceiling of 10%. Looking to the hue and cry being made by state government employees, now contribution by the state government and central government without any ceiling will be exempt. But in the case of private employees, it will continue to be 10%. Frankly, I am of the view employer-employee relationship is same whether it is central government employee or state government or a private sector employee. If central government is eligible to contribute up to 14%, which is contributing and which is considered to be exempt, there is no reason why a private employer contribution should be restricted to 10%. It should be 14%. You can say because central government contribute 14%, so it should be 14%. That's a distortion, discrimination, which should be avoided in tax law, mainly because you are sitting in power and you can draft the law and you put a higher figure and don't give them to other without making any issue why it should not be 14%. That's a discrimination, I believe, that need to be resorted. So these are the changes. There is no change so far salary income is concerned, and there is no change so far income from house property is concerned. Now coming to the business income, there are 4 major changes which may be relevant to you. I will just discuss on that part. One is section 28(4). This section was amended 12 years back to provide that any benefit or amenity if you have received from the business, then that will be considered to be income of the business. Because what was happening, many distributor, many dealer, many retailer were getting gift, holiday packages, visits to foreign destination, etc. from the company of which they happen to be distributor, dealer, etc. If I'm going to Bangkok, I'm going to Hong Kong, Singapore, London, UK, etc. holiday package, etc. or some expensive gifts were being given. That was made that such perks will be taxable in the hand of the business which is receiving it. But now the government says, having made a provision, but we are not able to control it because we do not have the information. In order to keep a control, now a new section 194R is being introduced in the TDS provision to provide that whosoever is giving such benefit or amenity to the dealer, distributor, retailer, etc., he will be required to deduct tax at source at the rate of 10%, and in case the total amount of the worker benefit exceed rupees 20,000. Now, this will be requirement, and in case, because all these are being given in kind, it is being further said, in case it is in kind and maybe difficult to deduct that amount, then he will ensure that this amount get deposited. And how it will get deposited? That he will collect from the dealers or distributors. So need to be paid distributor. Exclusion is that in case there is an individual and HF, and in case its turnover is less than 1 crore rupees, or a professional whose receipts, gross receipts are 50 lakh or less than 50 lakh rupees, then this provision will not be applicable, as other provision of TDS are not applicable. Then there is a change in section 37(1). We all know under section 37(1), expenditure incurred wholly and exclusive for the purpose of business is eligible for deduction, unless it is not a personal or a capital expenditure. Then there was a explanation 1 inserted to provide that any expenditure which is incurred, which is prohibited by law or which is an offense, then it is not eligible for deduction. So far so good, because that is good. Now there has been a controversy erupted whether an expenditure incurred by a pharma company in giving gift, etc., to doctor is considered to be prohibited by law or is an offense. Now there were some contradictory judgment on that part, because Medical Council of India has said that they should not give, and they have said that this is against the code of conduct. Code of conduct is a moral code of conduct, and that should not be, it is not a law, but still the law. Now, taking cue from the few of the judgment which are favorable, this will provide that not in one more explanation 3 has been inserted to explain explanation 1. There is section 37, there is subsection 1, there is explanation 1, and now there is explanation 3 to explain section explanation 1. For the purpose of explanation 1, the expenditure incurred shall be considered to be prohibited in case such expenditure is prohibited by any code of conduct or professional ethics, etc. Or composition money or expenditure is such which is prohibited or which is law or offense or law of any country outside India also. So in all 3 situations, the expenditure will not be allowed. The nutshell is that compounding fee paid with composition money, compounding fee paid will not be eligible for deduction. Expenditure incurred on doctor, etc., which under the Medical Council, etc., are not allowed or code of conduct is violation, that will not be eligible for expenditure. And any expenditure which is an offense or prohibited by law of any outside country also will also not be eligible for exemption. Third issue is regarding education and health and education cells. We all know that there is a section in income tax under section 40A(2), which says while computing business income tax paid is not an eligible deduction. I hope you all know about it in context. Now, in 2005, the government levied education and health cess. Now, in the last 3-4 years, a controversy has erupted whether this education and health cess can be said to be an income tax so as to be disallowed under section 48(2) of the Income Tax Act. The Bombay High Court in the case of Sesa Goa Limited held that it is not a tax to be considered under section 48(2), and if it is not an income tax, then it will be eligible for expenditure incurred for the purpose of business. The judgment, Chambal Fertilizer judgment of Rajasthan High Court also endorsed the same view. But recently, Kolkata bench of the ITAT analyzed all the judgment, and they got hold of an old judgment of the Supreme Court in Srinivasa case, where the court has held that surcharge, etc., they are also part of the income tax. And on that basis, they distinguished the judgment of the Kolkata High Court also, Bombay High Court as also Rajasthan High Court. Now, taking cue from that, this finance bill has proposed that education and health shall not be eligible for expenditure, and the judgment of Bombay High Court and Rajasthan High Court are per incurium, and that's why an amendment has been proposed, which will be retrospective in effect from assessment year 2005-06, meaning thereby now education and health cells will not be eligible for a deduction, and this deduction cannot be claimed on that part. So this is the nutshell of this provision on that part. Now I can switch over a little bit after this because there is no other amendment regarding capital gain. I switch over to this cryptocurrency or virtual digital assets, which is another controversy which was going on and which this budget is trying to settle down, because that will take a part of my other income from other sources also. As we all know, cryptocurrency has become more popular and there has been a phenomenal growth on this part. Some debate was going on whether it is legal or illegal, whether government of India should prohibit or not prohibit. And once the bill was ready to be introduced in Parliament, it was stopped. And then the government said we want a larger discussion. Now, in this finance bill, it has been proposed that any income arising from the transfer of a cryptocurrency, which they say virtual digital asset, will be liable for tax at a special rate of 30% under a new section 115BBH. It is just like 115BB, you might be knowing, 69A, there is a special rate of 60%. So in line with this, a new section 115BBH has been introduced, notwithstanding anything contained, any income on the transfer of foreigner. It has been further provided that no expenditure will be allowed against this. Whatever is the sale proceed, that will be done, only the cost of acquisition will be deducted. In case you incur any loss, that will not be allowed to be set off against any other income. In case you have loss, that will not allowed to be carried forward. So meaning thereby, whatever you have paid for purchase of that coin or that what we call cryptocurrency or asset, and whatever the sale price you have, difference will be liable for tax at the rate of 30%. I'm of the opinion in the same year, if you have loss and profit, then both can be adjusted. Though there can be a debate on that part also. But I am of the opinion that it is the income only can be taxed. And in case you have made a profit or loss, if you have made a 10,000 profit in one, or if you have made a loss in another, then difference can be worked out on that basis. But still there can be a debate on this one. But a challenge will be that in case on 29th March, you have incurred a loss of 8,000 rupees, on 2nd April, you have made a profit of 10,000 rupees. Since the year has changed, you will not be able to adjust because loss is not allowed to be carried forward. So meaning thereby, I am of the opinion that same year it may be there. Similarly, in reverse, if it happens, then again it will be the same issue. You will not be able to eligible to set off the losses on this. Now, in order to bring transparency and have an audit trail, a new section of TDS 197S is being introduced, putting an obligation on the purchaser to deduct tax at the rate of 1% at the time of payment or credit, whichever is earlier. Now you need to deduct on this issue, and that there are two thresholds for the purpose. One is 50,000 rupees for specified person and 10,000 rupees for other than specified person. In case you are a purchaser, you are not carrying on business, or if you are carrying on business, your turnover is less than 1 crore rupees, or if you are carrying on profession, your turnover is less than 50,000 rupees. This obligation to deduct TDS will not be applicable in case you are making payment of less than 50,000 rupees. But in the other case, it will be 10,000 rupees only. So 1% has to be deducted and paid on that part on this. There may be challenges now that how you will make from whom you will deduct. You are purchasing on an exchange, and how you will deduct an exchange. Now there will be a challenge whether you will deduct of exchange or the person you may be knowing or not knowing, that may be challenge. I may just say clarify that these provisions per se do not legitimate or legalize investment or purchase of this cryptocurrency. As a resident, one is liable and one is obligation under obligation to comply with the FEMA law. So you cannot make any purchase outside India without through authorized dealers, etc. So you have to, in case your rupee payment ultimately lead to flow of exchange outside, there can be a violation of the FEMA law also. If you are doing within the India, then there is no issue, I believe in this. There may be debate whether it is legal or illegal, that's a separate issue. But I am of the view the only controversy which has been settled is that it will be liable for 30%. This provision will be applicable from 1st April 2022. So what will happen is till 31st March, it will be taxable at a normal income. Don't believe that this is not taxable up to 31st March 2022. Because under the income tax law, a resident is liable to pay tax on his total income irrespective of the source. And no exemption is there, and all income is liable for tax unless there is a specific exemption under the Income Tax Act. And in the Income Tax Act, we all know there is no such exemption to anybody from tax on this part also. So on that part, the tax will be required to be paid even up to 31st March 22. There may be a debate up to 31st March 22 whether I should consider as a business income, a capital gain, or income from other sources, or but it will be liable to tax at a slab rate. If you are filing a slab of less than 10 lakh rupees, you pay 20%. If you are filing beyond 10 lakh rupees, then 30%. That's the only issue which is there. One thing more which has been taken care of is that one can make a gift in cryptocurrency also. So in keeping that in mind, 56(2)(10), which provide any gift from a known relative is liable for tax. The definition of property is being widened in section 56(2)(7) to include virtual digital asset also as a property. So anybody who received this cryptocurrency from any other person free of any amount or any amount which is less than the fair market value of that asset as on that day to be computed, and that difference is more than 50,000 rupees, it will be deemed to be the income of other source, income from other sources of the person who is receiving this. So these are the amendment which has been made and proposed in this part. So this is on the for the part of the cryptocurrency. Now there is another provision which may be of interest is section 68. We all know section 68 talks of cash credit, puts an onus of the person in his books any amount is found credited to explain the nature and source. In 2012, and proviso was added in respect of share capital and share premium, and putting an obligation in case SSC is a company to not only explain the nature and source of the shareholder from where the money has been received, but also nature and source of the shareholder from where he has received. So that was the obligation which has been put. Now the scope is being widened to putting an obligation, loan and similar borrowing, if any money has been borrowed, which is found credited in the books of account. Not only the nature and source is to be explained by the SSC, but nature and source is also to be explained by the lender or the person who has given the money from where he has got this money and how he has paid this money. This is an extra obligation which is being implemented from 1st April 2022. There is no exception on this part, and the proviso has been worded in a negative way that in case nature and source is not explained, then it shall be deemed to be income of the current. Now the problem is that there is no exception even for bank, for NBFC, etc. If you take a bank loan also, say from State Bank of India or an Indian Bank or a Canara Bank, now bank will be required from which source you have given the money. Loan has been given. Though intention is not there like this, but the language which I say is like that 68. Then there is another amendment in section 94. We all know section 94 is an anti-tax avoidance provision. And there is a subsection 7, which subsection 8, which talks about of dividend stripping and unit stripping. You believe there's many in the mutual fund, there used to be a dividend stripping that you buy unit which has a book value at 20 rupees today, and tomorrow that dividend is declared by that mutual fund, say 10 rupees, its value goes down, and that 10 rupees used to be exempt. And if you sell the unit later on of 20 rupees at 10 rupees, you have to get a loss. In order to address this issue and to address the issue of a dividend which a company come dividend and next dividend, you have bought a share of 100 rupees and tomorrow dividend is declared at 10 rupees. So amendment was made in 94(7) and 94(8) that in case you have made a purchase within 3 months from the date of book closure and you have sold it within 9 months after the book closure, so any income which you have received in between which is exempt shall be deemed to be reduced, cost shall be reduced to the extent the asset which you are selling within the 9 months. So it was a dividend stripping measure which was introduced. Now 3 years back, government has introduced InvITs unit, which is called investment unit, and REITs. You might say, we have seen that various developers have promoted Brookfield and this in Bangalore, Shobha developer, etc. They have issued this InvIT. They are units where you receive regular income and there can be a dividend stripping type mechanism there also. Same is also being done in bonus share of a listed companies also. You buy a share of State Bank of India today at 100 rupees, and tomorrow State Bank of India declares a bonus 1 for 1, and then later on third day you sell the share at 50 rupees because the share has become, after bonus I value at 50 rupees, then 50 rupees the loss which you have incurred on the original investment, and your bonus share value is 0. In order to address this dividend stripping, bonus stripping, this finance bill proposes that in case there is a bonus stripping also, then that loss which you incur will not be allowed, but such loss will be considered to be the cost of the bonus share or the units. If I can give you an example, in the present case, if you have bought a share of 100 rupees and there are 50 rupees, and this share has been purchased within a period of 3 months from the date of book closure. Say today is 3rd of February, and you buy share today, and State Bank of India declares bonus, and we say the book closure will be on 31st March 2022. So your purchase is falling within 3 months. And then if you sell share within 9 months, that before 31st December 2022, and the share rate at that time is 60 rupees. And since you have bought 100 rupees, and you are having 1-to-1 share, so your 100 shares are at 100 rupees, 100 share at 0 rupees. So if you sell 100 shares which you have bought earlier of 100 rupees, selling at 60 rupees, you will incur a loss of 40 rupees. But that loss will not be allowed and will not be set off. But this 40 rupees will be considered to be cost of your bonus share, which is 0 value cost. So you will be eligible to do that. I believe this is restoration of the earlier judgment which Supreme Court has given before this amendment was made, where they said keep bonus value, share value will be taken 0, looking to the complexity. In Anarkali, judgment is there of Supreme Court, which is a famous judgment, which has laid down the law how to value the share, bonus share, in case bonus has been declared. At that time, it normally was if you are 100 share at 100 rupees and then bonus is 1-to-1, 200 share value is 50 rupees. That was the judgment with the Supreme Court. Similar was the right issue on Anarkali. But government later on said we cannot keep a track like this. We will keep original cost at the original cost and the bonus share 0 value at 0 cost. Now we are going back on the track same way of Anarkali judgment. That's a 94. Having said so, now I change gears and I go to 2-3 provision which are procedural provision. One is section 139(1), which deal with the provision of filing return. We all know that under section 139(1), we are supposed to file the return by the due date, which happened to be 31st July or 31st October or 30th November in TP cases. Then we all know that in case we have not filed the return in 139(4), we used to have the right to file the return before the end of the assessment year, but after the amendment, the period has been reduced to 3 months before the end of the assessment year, which means 31st December. Then there used to be a period for revision under 139(4). After filing the return, you find out any omission or failure to correct the return. There used to be earlier 2-year period from the end of the assessment year. It was reduced to 1 year, and now last budget has reduced it to 3 months before the end of the assessment year. Meaning thereby, in the same assessment year, you can do whatever on the part of now. But thereafter, there is no right to file the return of income. Now, government has thought that some mechanism has to be given for correction of the returns. And they have found out a new way, update your return. And you can update your return within a period of 2 years from the end of the assessment year. You can update your return within a period of 2 years from the end of the assessment return. And then there is an obligation put on you. Who can do it and what will be the cost? First, what will be the cost? They say whatever is the tax, interest, etc. after inclusion of additional income that you need to pay, but on that amount which you have to pay, 25% extra you need to pay if you are updating your return within 1 year from the end of the assessment year. But if you are updating it after 1 year, but within 2 years, then you need to pay 50%. Huge cost. I'm just wondering, earlier I was having a right to revise within 1 year or 2 years. It is the same mechanism. There is a revision of return. And I was supposed to pay tax and interest only, nothing more. You have curtailed the period, but you have brought the period back in other form, asking me to pay 25% more or 50% more. That's the mechanism which has been worked out. But after 2 years, nothing you can do, no issue. Then it will be a 147, 148, that procedure. And now, what are the conditions? Who can file or who cannot file? There are conditions. In case your case has been done, assessment or reassessment has been done, or it is pending, then you are not eligible to do it. In case search has been carried out on you, then you are not eligible to do it. A survey has been carried out, then you are not eligible to do it. In case a notice has been issued to you under PMLA or Benami Act or Coffee Posa, then you are not eligible. If a prosecution has been launched against you, then you are not eligible. There are lots of conditions on this issue. But this is one of the provision which has come up, and probably the idea is that the new procedure of reassessment where 148 notice is to be issued before after inquiry. So their idea is that in case when we issue a notice for inquiry that we have got this information, it will give an option to you to come back and to file the return and to do correction on that part. So these are the provision which need to be looked into, and one mechanism has been created. Looking to time constraint, I am not going into much nitty-gritties on that part. So that's one scenario which has been created on. Second is the faceless assessment. For the last 3 years, faceless has become a new word for the income tax department. They started with e-assessment. They introduced a faceless assessment scheme by notifying a scheme. Then they introduced 144B provision last year, and now this year they are revamping it. And on top of it, in all earlier schemes, they have said, we may or may not give you an opportunity of physical hearing. And that matter was under challenge before the courts. The courts have taken a very harsh view that this is not done. But one interesting provision was there, 144B9, which is say that in case you have passed an assessment order in violation or by not following any of the procedure prescribed in section 144B, that order will be known as. Now looking to the two harsh provision, that order will be known as and there will be a violation of the procedure. We all know assessing officers do commit mistakes, etc. while doing assessment. Now that 144B9 is being deleted. And in place of existing 144B 1 to 8, new 144B provision has been introduced. And the major change in that provision is only one, that now as a matter of right, physical hearing through video conferencing had to be given. In case any assessee taxpayer wants any physical hearing through video conferencing, it has to be allowed. It will not be an optional. This is a well-settled principle of natural justice. Supreme Court and Appellate Court have reiterated a number of times. You cannot condemn a person without giving a hearing, just on the page of paper. So my suggestion to all of you will be that when any notice, any scrutiny notice, or any other notice comes up, the last sentence of each your letter should be, please allow me a personal hearing through video conference. I hereby seek a personal hearing through video conference. This should be your template of every letter you write to the department in response to any notice, so that you don't miss it out. As we write now in the last, thanking you, yours faithfully. Before that, the line should be very clear. I hereby seek a personal hearing through video conference. That should be letter, so avoid any content, because the law is clear. In case you don't seek, then he is not obliged to give you a hearing on that part. So this is the amendment which has been made on procedural part of the amendment. Then there is another amendment regarding the income escaping assessment, reassessment, etc. Last year, the entire scheme was changed. Consequent to that, notices issued after 31st March have been quashed by various high courts. I'm not aware of the judgment from any southern India high courts, but Allahabad High Court, Delhi High Court, Rajasthan High Court, Calcutta High Court have already quashed notices on that part. Chhattisgarh High Court, of course, has gone against on that part, and SLP again, that is pending it. So that's a separate part. The new procedure is, I'm not going into. But this time, there are 2-3 amendments which may be relevant to part it out. One is, earlier there was, before issue of a notice to you, approval was required. Now that approval has been withdrawn, which was rightly done, because there were earlier 4 approvals which now get restricted to 2. Before issuing an inquiry, he will have to issue a notice, or he has to seek an approval. And then second, before passing an order, he has to seek an approval, which will be fair enough. But the main problem is, last year, we all know that before last year, that department has a right to reopen the assessment for up to 6 years. In case 143.3, then for 4 years, subject to certain conditions, and then 6 years, up to 6 years, beyond 6 years. And in last year budget, a specific explanation was inserted that in case that in order to reduce the period of litigation, ease of doing business, bringing more confidence in the taxpayer, we are reducing the period for reopening the assessment to 3 years, and beyond 3 years it will be reopened only when we found any assets beyond any income escaping assessment which is represented by assets, and then example of assets was also given: bank balance, securities, property, etc. Now a U-turn has been taken in this bill 2022, providing that beyond 3 year assessment can be opened not only when income escaping assessment has been represented by assets, but also where expenditure has been incurred for any event or something like this, or also where entries or on the basis of income has escaped assessment on the basis of entry or entries in the books of account. Now I wonder, if basis of entry or entries in the books of account and expenditure is subject matter of reopening assessment, in all cases this allegation will come up, because at the end of the day, for income escaping assessment there has to be some entry in the books of accounts. So in the moment the amount exceed, only threshold will be that 50 lakh will be helpful only. And in 50 lakh also there is a catch, where the income likely to exceed, actual income may not be more. So even if there is allegation 40 lakh and assessing officer believe that it is more than 50 lakh, then you can reopen the assessment. This is the major change which is being proposed in 147, 148. I will say the new provision, which was introduced in 21, still to be applied, but before application we are having a U-turn, taking a U-turn on that part. So this is another change which is coming up on that part. Then there is some change in 156. I need not refer to on 156, where because of IBC merger, demerger, any demand get waived off, etc. The assessing officer will have a right to write off the demand and issue a new demand notice. 156A is there. Then we have a 158BA provision which provide for keeping the litigation in abeyance in a similar issues pending. So instead of that, a new 158B provision is being introduced, whereby in case a favorable order has come in favor of an SSC or of High Court, Supreme Court, or similar order is pending, something like this, then a collegium can decide not to file an appeal against the order of the CITA or against the order of the tribunal to the High Court in similar issues pending after obtaining a consent of the SSC. I am of the view, frankly, why the SSC will give a consent? When a favorable order is already there of a higher court, let the department file an appeal and get it dismissed. At the end of the day, it takes 5 minutes in case the favorable question of law and the similar has been decided, so quickly it gets disposed of. On the contrary, the benefit may come up because of the tax effect. The department will not be able to go to the higher forum. If the CIT appeal has decided an issue and department want to go to the tribunal, and issue is covered by the judgment of tribunal in your favor, and department files an appeal in tribunal, and that get disposed of in your favor because tribunal has already given, and demand is between 50 lakh to 1 crore rupees, then department cannot go to the High Court. I don't think why it is. And then it is a collegium. Our experience with DRP has not been happy. We all know 3 commissioner sits, and by and large relief is not given on one pretext, because 3 people are not able to reach consensus, or secondly, department does not have a right to file an appeal against it. And in case we give a relief, department will lose the right to file an appeal. Surprisingly, and in many of the cases, even the High Court, Supreme Court orders are not being followed. This is one like this issue. So these are the changes which have been proposed on that part. Then there, I'm skipping in between. Then I go to 194 IA. We all know any person who's buying a immovable property other than the agriculture land, if the consideration is 50 lakh rupees or more, then 1% TDS has to be deducted. So now this Finance Bill 2022 is proposing that this 1% is to be deducted higher of the two, that is actual consideration or the circle rate, what we call the local rate value, circle rate of that area, whichever is higher. So in case circle rate of the property which you are buying is 50 lakh or more, and the consideration is 45 lakh rupees, then you need to deduct TDS. In case circle rate is 45 lakh rupees and actual rate is 50 lakh, 2 lakh rupees you are buying, then you need to deduct TDS. But if both are below 50 lakh rupees, then you need not do it. But take care, no discount of 10% which is available for purpose of 50C or 56 to 10 is available in 194 IA. You have to deduct irrespective fact whether it is within 10% also. Still you will have to deduct TDS. Suppose the circle rate is 53 lakhs. You have bought for 49 lakh and it falls within 10%. Then you have to deduct on 53 lakh rupees, 53,000 rupees. That you have to deduct 1%. You cannot say that it is not required to be deducted because it is within 10%. So this is the 194I amendment on that part. Now there are some other consequential amendment in section 79, 79A, 179, 179 about merger, demerger, etc. Looking to the time constraint, so I can skip it part. And in case you have a question answer session, we can take some question answer. What is the program now? It is 7.6. So I leave it to you. What should be done? I can explain few more clauses, or I can skip all that part.
I will go up to 5-10 minutes, and then we'll take up few.
One thing I have forgotten about the charitable trust. I think I just touched upon 5 minutes of charitable trust. So
Yes.
I think maybe charitable trust or institution which get exemption under section 1023C or section 11 or 12 are always on the hit list and radar of the income tax department. I could not make out why they are so harsh on this charitable trust institution. All these NGOs are rendering a valuable service to the society, and there is no reason to be harsh with these institutions. But I don't know why. What is the thought process? And this budget also have at least 35 pages in the memorandum making various amendments to the charitable trust society. There are so many clauses amending one after the other to charitable trust society. I will just summarize 5-10, which are the major changes which are being proposed. They say 1023C is one regime, 1112 is second regime. Both are having different provision. Let us try to converse and merge bigger. And in that process, they have made the situation more complex. First thing, now they have noticed that both 1023C or section 11 both have provision for audit, but both do not have a provision to maintenance of books of accounts. Now amendment is being proposed that all these trusts, society, etc., beyond the threshold which audit threshold is there, they will be required to maintain books of accounts. This is the first change which they have proposed. Second change, in case assessing officer does not give you exemption, he says that you are not eligible for exemption for one region or the other region, how the income is to be computed of a charitable trust institution? This is the second question. They say whether the gross receipt or any deduction for expenses should be allowed. Now they say no. We will say gross receipt minus expenses incurred for the purpose for object of the society. That we will allow you. But 4 conditions we have to fulfill. Any expenditure which has been incurred out of the corpus will not be eligible for deduction. Any expenditure which has been incurred out of charity and donation will not be eligible for deduction. Any expenditure which has been incurred by taking loans or borrowing, that will not be eligible. Depreciation shall not be allowed in respect of any asset which has been considered for as application of it. These 4 conditions will be applicable in both cases, 1023C and 11 and 12. Secondly, while computing income, provision of section 40A3 will be applicable. Provision of section 40AI will also be applicable. 40A will also be applicable. So meaning thereby, no deduction of TDS you have to fail or cash payment, etc. That will also not be paid. The third controversy was that what happened in case I have not spent 85% of expenditure and I was entitled to accumulate it. For section 11-12, there was a form 10 which you were supposed to file and you can accumulate 5 years. For 1023C, there was no such requirement. Now for 1023C also, there will be a requirement that you need to file a form 10 for that purpose for accumulation. Another controversy was that in case it is 5-year period, whether tax is to be levied after the expiry of 5 years or in the 5th year. As per the present provision interpretation under section 11-12, it was after the 5 year, that is 6th year, and in 1023C, it was the 5th year. Now, taking cue from this controversy, they say it will be the 5th year, so you need to spend by 5th year. But if you don't spend by 5th year, then within the 5th year, it will get taxed on that part. That's a change which has been brought on that part. Now another change is for temple, masjid, gurdwaras, mosque, etc. or that purpose. They all received contribution, voluntary donation, etc. They need to identify the contribution or donation they have received for repair of things like this, whether it is a corpus or whether it is not a voluntary. Wherever they identify, then they have to incur that expenditure only for that purpose. And they cannot use that amount for any other purposes. That's another obligation which comes. Another change is wherever the commissioner has the power to cancel the registration, and while cancelling the registration, he has to take a decision within 6 months from the end of the quarter in which the notice is issued. This is another requirement pertaining time. Where assessing officer recommend to the CIT, then assessment order can be kept in abeyance, and that period will get excluded, during which the CIT takes a decision about cancellation of registration. One positive change is there. There is a section 13(1)(c). Probably you know, section 13 puts an obligation that conditions to be complied with by a trust or society who get a registration under section 12. And they say benefit of section 11(12) will not be available in case you violate any of the conditions. And 13(1)(c) is one condition whereby in case any benefit has been given or to any person, settler or a office bearer or a relative, an amount has been paid beyond the reasonable amount for which he is entitled to, then that amount is not eligible for deduction. Our view was it is not eligible for deduction, but department contention was that once you violate this, then you lose all benefit and you are not eligible for exemption, and even registration used to be cancelled. Now, in order to settle this controversy, now it is being said that in case there is a violation like this, the amount which is in excess of the reasonable amount will be deemed to be the income of the person who has received it, and that income will be liable for maximum marginal rate like cryptocurrency under a new provision after cryptocurrency 115 BBI. Cryptocurrency new section is BBH, it is BBI. So the person who has received, he need to pay maximum marginal rate tax 30% plus surcharge, whatever applicable, on such excess amount which he has received on the beyond. I believe whatever he has received, he will be paying a normal tax. On this, he will be 30% plus. On top of it, there is another provision. Trust will be required to pay penalty. A new provision 271AA is being introduced on the total amount so paid, 100% penalty if the default is in the first time. So in 1 year you have paid and that default is there, in that whatever amount you have paid excess, then 100% penalty will be levied on the trust or society. And in subsequent year the same default is there, then it is 200% of the amount. It is not tax of 30%. If you have paid a salary of to one person 6 lakh rupees and AO says that he is not entitled for 6 lakh rupees, entitled for 2 lakh rupees, 4 lakh rupees will be the penalty and 4 lakh will be liable for 30% there. Subsequent 8 lakh will be the penalty. But the plus point is exemption will not be denied. I believe that is a relief which has come up on this issue. So these are the various provisions which have been introduced on that part. And these are the various provisions. I have tried to explain it. So now I over to you, I believe, Mr. Panaraj, if he's there. And
Yes, sir. Yes, sir. Thank you, sir. Thank you very much, sir. Now we will take up the queries.
The screen visible, sir? Excel sheet. So from second, yes.
now these are the questions which you have put on the screen.
So these are the questions that came up, sir. From second question onwards, we'll take it up. Sir.
What is the limit of 1 crore under section 194R is for provider or receiver? This question is provider. Because obligation to deduct tax is on the provider. In case a provider is an individual and HCF, that it is only the provider who provide it. What about the input tax difference which we can claim before next September and restriction imposed? I believe this is regarding GST, I believe, indirect taxes.
No, Prasanna,
So Prasanna, Krishnan, if you want to take it on that.
Yeah, you can complete, then I can add because it will be intervening. Your flow is nice. Happy to hear musically.
All right. How 48.2
Yeah.
can be made retrospective when it is clarificatory in nature as far as cess is concerned? No, Parliament has a right to make a retrospective amendment. You cannot Parliament right. Only thing arises is when the legislature says that this amendment shall be clarificatory but is effective from 1st April 21 or 22, then it is not retrospective. But here the bill itself is saying that this amendment is retrospective and shall have effect from 1st April 2005, effective from assessment year 2005-6. So then I don't think there can be any dispute about that. This will be a retrospective. Can monetary support provided to the family of the person deceased due to COVID pandemic, a non-employee, as usual, will be claimed a deduction from the business income? I say no. I think that cannot be done. In case it is non-employee family, in case he is a family person of the employee, then it will be 37 because you need to cross the hurdle of 37(1). Then it will be like a charity which you are doing it. I will suggest to go to CSR for this purpose rather than on this purpose. Whether income from virtual asset is subject to tax after applying slab rate or is it taxable? I said now up to 31st March 22, since there is no law on that point, it will be slab rate, but beyond after 1st April 22, it will be state 30% from ₹1. Whether the term loan or borrowing under section 68 and term money under section 16 are two different concepts. Section 16A source of source is not mandatory. No. 68 is a credit in the books of account. 69 and 69A are the investments. So investment from undisclosed sources which you are not able to explain. So these are two different provisions. So the moment you will say this 69 that I have received this money from some other person, then it will get converted to 68 and otherwise not. The language of section 139(8) does not restrict filing updated return for earlier years, say 17-18. How this is possible to file before 31st March 20, especially when the SSC plan to escape it. See, this provision will come into force. It is not in force today. This provision will come into force on 1st April 2022. And this provision gives you an option of filing a return for 2 years from the end of the assessment year. So on 1st April 2022, you will be in a position to file return only of 2021 and you cannot file of 1920 assessment year because 2 years would have ended by on 1st April 2022. Sir, suppose I filed the revised return for assessment, can I still file updated return for the same as per law? I think as I gave you example, 21-22, you will be in a position to file the revised return. No, you can file the return today also for assessment year 21-22 because the period stand extended because of the COVID. 31st March, I think the period available to you under the present law also. But in case you are not willing today and you want to take the benefit and go do charity to the government by paying 25% extra, you are welcome to do it up after 1st April 2022. COVID expenditure or COVID treatment during 20 SSC be able to take deduction now. I think that's a lacuna which has come up because there was a press release. We have advised people to claim deduction, but in case you have not claimed deduction, I will suggest to file a revised return. Over to Prasanna ji for this question of second question, third question.
Thank you, Vijay. That's a sharp point actually. As we had discussed, the amendment relating to this 2B section 37 are all prospective. We are just waiting from the date of enactment only it is going to come. It's not retrospective. As far as September 2021 referred here is concerned, what you are referring to is 2021 financial year, which could have got the extended time for setting right or claiming your IT differences and all till September 21. That remains as such without any disturbance. If your 2B is not showing or what to do it, 2B was not a criterion at all till September 21 or even today also. Recently only 2B is coming to the importance for the financial year 21-22. Okay, so that's the case. If you are having 2A supporting you, if you are having invoice in your hand, if you have got your services or goods received duly evidenced, maybe with the EWB supporting you, bill supporting you, perfectly you can claim credit. 2A is a great supporter for you, go by that one. 2B is not at all relevant for September 21, as I had explained in the discussion.
Yes, over. Questions are over, Selva?
Those are questions.
Yeah.
Any fresh questions? No, right?
No.
There's a possibility of seeing the viewers who are having an interaction one-to-one with the viewers, or no possibility? Nobody can raise.
So there is no possibility for them to unmute and turn on the camera. This is a webinar pattern.
Even audio is not possible of the viewers?
No, sir. They're joining in a browser. So those who are joining in a application, they might unmute and speak. We'll try to unmute them.
All right. No issue.
So, shall we wait?
Yes, sir. So we'll take up.
Okay, sir. Thank you very much to both of you, Jain sir and Prasanna Krishnan sir, for your time and your experience and your presentation in such a lucid manner, and making the things very clear to the members. And if at all there are any queries, they will mail you. If possible, please respond to them. So this, from SIRC point of view, we are done with this today's program. Even though it is a repeated program, more than 800 members joined today's program. Yesterday it was by Vaidishwaran sir on indirect tax and Bhupati sir on direct taxes. And we knew this many would not have attended. So we repeated the program equally. Yesterday also around 800 people were there. And I thank each one of the members who have participated in this discussion and made use of this program. And we are really happy to see that so many members are benefited with this program. And you are the reason, and your inspiration and support is the cause for our conducting programs of this nature. So, but for the time and efforts of the commitment of the stalwarts like Jain sir and Prasanna Krishnan sir, such programs would not be possible. So with folded hands, I thank on behalf of SIRC and all the viewers here for your time and your exchange of your experience on this.
Thank you, Mr. Panaraj. Thanks to all participants for being giving me these opportunities. It was really a pleasure to interact. And feel free to interact if you have any questions. Thank you, and wish you all the best. Be safe. Take care.
Yes, sir. Thank you very much.
Thank you. Thank you, Mr. Panaraj, and all the audience.
Yes, thank you, sir. I also thank the chairman in absentia for conceptualizing this program, and Mr. Selva, the real tech hero for us, who can make this possible by removing all the technical glitches, and also the back office of SIRC. And thank you all once again. Thank you. Jai Hind, Jai ICAI.
Thank you.